Okay, so today what we're going to do is we're going to look at strategic investments. So just a little recap. What we've done for chapter 15 up until today was non-strategic investments, okay? So that's where we're buying shares of a company or we are buying debt, which are bonds of another company, okay? Giving us less than 20% ownership. Okay, so let's just say that there's, we buy 1,000 shares, and then there are, I don't know, 100,000 shares outstanding, okay? That gives us 1% ownership. We're not gonna have any control, okay? So all we do is we will just record as a non-strategic investment. Now, and also with the non-strategic investment, so we're either looking at less than 20% ownership or holding it for a short period, okay? So it's always usually it's gonna go as a current asset. Now let's get to the next step, dealing with strategic investments, okay? So they're called strategic investments, also called investments in associates. So we're starting on slide 28 and on page 1000. Okay. So what happens? Well, in this scenario here, what if we would have bought, instead of 1,000 shares of a company, we buy 25,000. Well, that falls between 20 and 50%, okay? So all of a sudden we know that, okay, it's no longer a non-strategic investment. It's a strategic investment. Why? Well, because we own between that 20 and 50% ownership. We have control, but we don't have complete control. Okay, so we've got to record the transaction a little bit differently, okay? Now, in this case here, again, we're gonna record it using the equity method, okay, which is used to account for long-term share investments with that significant influence, okay? So again, we have significant influence. Why? Again, because of the ownership structure. We own 20 to 50%. We can exert some influence. I mean, someone may own, in this case, maybe 49%, maybe 51%, okay? So they're gonna have control over us, but we still will have some influence. So we've really got to read the narrative as to how much we owe, okay? Because that's gonna determine how we record it on our, or in our books, okay? So the first thing we wanna do, which is the same as when we were dealing with a non-strategic investment owning less than 20%, we wanna record the purchase of those company shares at cost, okay? So same thing, okay? Just like yesterday and the day before. We buy X amount of shares for X amount of dollars. Debit our investment, credit cash, okay? So let's look at the scenario here on page 1000. So it says we're gonna use the equity method. Now, to illustrate, Mike Ron purchases 3,000 shares, which is 30%. Of OPT common shares for a total cost of $70,650. We need to record this purchase as of January 1st because obviously that's the date we bought. Okay, so a little bit different. January 1, it almost looks the same, just the accounts that we're going to use are slightly different. So investment in associate, and then we'll OPT. And credit cash. Okay, so we purchased 3,000 shares, that's 30%, so there must have been 10,000 shares outstanding. The total is debit $70,650 to the investment in associate, credit cash $70,650. Okay, now the only difference there when we purchase the investment in an associate, because again it's at 30% rather than 20 or less than 20, is that before, when it was less than 20%, we just said investment and then the company name, okay? In this case here, we got to signify that's an investment in associate and the company name OPT. Now, using the equity method, It's a bit different when we close our books, okay? So let's go to the top of page 1001. Notice it says, under the equity method, the investor records its share of the investee's earnings and dividends. This means that when OPT closes its books and reports profit of $20,000 for 2020, Micron, which is our company, we're the one that invested in OPT, okay, is going to record 30% of the share of that of OPT's earnings, okay? So 30% times 20,000 is $6,000, okay? So 20,000 was their net income times 30% gives us $6,000, okay? So again, we record our purchase. Now, whenever we get dividends or we got to close out the year, okay, we've got to record an equity adjustment in our books, okay? So December 31st comes along. Okay. Debit 6,000, credit 6,000. But what are we debiting? What are we crediting? Okay, so at the end of the year, again, before what we used to do is at the end of the year, we'd make a fair value adjustment. Here we don't have to make a fair value adjustment, okay? And when we record the dividend, it's gonna be a different way of recording it, okay? So again, end of the year, what's $6,000? Where does that come from? Well, OPT made $20,000 for the year. We own 30%. Okay, so what's that going to do? Well, we want to bump up the investment in associate. Okay. So now our investment is not worth $70,650, it's worth $76,650. And we're going to credit investment income. Okay. Now, let's just say that this company made 20,000. If they would have lost 20,000, this just would have been the reverse. We would have debited investment loss 6,000, credited investment in associates 6,000, and our investment would have dropped from 70,650 to 64,650. Okay. So again, we record the purchase, we record our share of the net income, again 30% of the 20,000. Now, notice in the middle of the page that OPT pays a dividend. Okay, so they're going to pay us, in this case here, $3,000. So they pay that out on January 9th. Okay, so they give us cash $3,000. So we got to put the cash somewhere. Well, debit cash, we're going to put it in the bank account. What's the credit? Well, before, when we were looking at non-strategic investments, right, the credit went against investment income, just like we did here. But we don't do that when we have a strategic investment, okay? So when we're getting paid out for a strategic investment, so only between 20 and 50%, that dividend is no longer dividend income or investment income. We actually have to adjust our position, our equity or ownership position in OPT, okay? So we want to credit investment in associate OPT. So in the end, after we do all this, what's the value of OPT on our books? Well, we start with 70,650 plus the 6,000 minus the 3,000. So at the end, if this was in a T account, right, it would be 60, 64, 67, 650. Okay. So again, and then you just go back and forth, depending on what the net income is. Okay. And if there's a dividend paid, again, we always got to record the cash. Now, we go on and we make these adjustments on a yearly basis. Now what? What if we happen to sell? Okay, because that's going to happen. Eventually we're going to want to sell that investment. Okay, so I'm just going to erase the first entry. But we know the value on our books right now is $67,650. Okay. Now, here, what did I do something wrong? I did do something wrong. I added wrong. Okay. How did I add wrong? Well, 70,650 plus 6,000 here minus 3,000 here is not 67,650. It's actually 73,650. Okay. Anyways, let's now go to page 101. So as time goes on, we want to sell our shares. Okay, great. So let's assume that Micron sells those OPT shares for $80,000. Now, what would the entry be? Okay, so we receive cash. So debit cash, 80,000. Right? Now, that investment is on our books at 73,650. So we sold that. $73,650 gets the credit. So now that's off our books. Well, we got more cash than it was valued for on our books. So that's going to be a gain. Okay. So you could put gain on sale of investment, or in the textbook likes to use investment income. You can use that if you want. And that gets the credit of $6,350 in order to balance out our journal entry. Okay. So that's the big difference in investment in associates, okay, or a strategic investment versus a non-strategic investment, okay? So really we're bumping our investment up and down based on our ownership level of the other company that we own, okay? So when it's a non-strategic investment, we just record the dividend, okay? We don't make an adjustment to our equity level, okay? So that is going to wrap up chapter 15. Now, one might ask, well, what happens then? You're using this 50%. Well, what happens if you own 59% or 60 or 80? Well, what happens then is it is a business combination. Okay, so what we're going to do is we're going to combine all our companies together at the end, and we're going to consolidate our financial statements. But for our purposes right now, let's just know non-strategic investments, so less than 20%, and let's know how to record a strategic investment between 20 and 50% ownership. Okay, so the three questions that I'm assigning, okay, they're not hard, but they're not easy. Okay, so I'd like you to do those today, and tomorrow we'll take a look at them and we'll assign another question. Again, there is a question like this on the exam, but what it's going to be is you're going to be given a bunch of different scenarios, okay, and you're going to have to determine, are these share purchases, are they strategic, are they non-strategic? And then throughout the year, you're going to get paid a dividend. Well, again, if it's a dividend on a non-strategic investment, it's strictly dividend income or investment income. If it's a strategic investment, we've got to remember, a dividend income, we're going to get cash, but we've got to reduce our equity investment or our equity value in that investment. Okay, so that's the two big things right now. So that wraps up chapter 15. Again, it's not that difficult. It's just a matter of wrapping your head around, again, owning less than 20% or between 20 and 50%. Okay, so a good example, and it's called demonstration problem, and it's on page 1007. Okay, it shows all the different scenarios, okay, of owning investments. So it looks at non-strategic investments from purchasing bonds or purchasing shares, and then we look at our investment in associates. Okay, when you have an investment in an associate, which is a strategic investment, it's only buying shares, okay? You can't have an investment in associate by buying bonds. You just can't, okay? So again, those are the two types of scenarios. That covers chapter 15. So what I'd like you to do again, do those 3 questions, and then the next day we're gonna review them, and I'll sign a couple more for review. Okay, so that's it for today. If you have any questions, please let me know. Have a good day.